We want to welcome you to join us. My name is Andy Tomat, and along with my co-producers, Stan Tomsic, who's in the back, and Lynn Foster, we are pleased to welcome you to this forum, which we have entitled, we tried to be a little clever, 3 PhDs and a Dog, What Precedes Precede in terms of funding. We have dedicated this year of our forum to the memory of our founder, Nick Nichols, who started the Caltech Entrepreneurs Forum 40 years ago with the intention of exposing Caltech students to entrepreneurship. And at that time, 40 years ago, entrepreneurship was not viewed, especially by the Caltech faculty, as a viable career option for our distinguished graduates. How times have changed. But the topic of today's forum is really much in keeping with what Nick was trying to establish with the forum. Our sponsors, let's see. Our sponsors, which allow us to keep this session free for Caltech students, as well as relatively inexpensive for everybody else, include Avid Bank. I don't think Randy's here today, but Randy Churchill's with Avid Bank. The law firm of O'Milvey. I think I saw Scott. There's Scott. Okay. Thank you. Law firm of Lewis Roca. Sean's not here, but another firm. And then Mandela Space Ventures with Dr. Leon here and Irina. And longtime member, board member, Mike Nielsen. Here. Mike Nielsen, so great. So by way of introduction, I'm involved with corporate venture capital investing. And as this chart shows, this is from PitchBook, if anybody loves stats and wants to get information on that. The past 2 years have turned from being very startup friendly in terms of raising money to being very investor friendly in terms of a challenge. You'll see that as we look at the run rate right now, we're about half what it was back in 2022. No longer angels and early stage investors willing to throw a ton of cash at anyone with a Caltech PhD or USC, but just because they have a great idea. As we'll hear, the journey through the so-called valley of death just became twice as hard. But as we'll also hear from our speakers, there are great companies that are being founded here in LA. They're finding ways through other alternative ways of financing, through incubators, and through even seed funds established by both great institutions represented here, to get their compelling products, innovative services into the hands of real customers, which is what, as investors, we really look for. So they can get to the level where they can secure one of those 7-figure seed or pre-seed rounds. So our first speaker, Julie Schoenfeld, is a Caltech entrepreneur in residence. At Caltech, she co-led the formation of the Caltech Seed Fund and has helped launch and invest more than 25 new companies based on Caltech IP. Julie herself has founded and led 4 venture-backed startups, including Strobe, a 3D LiDAR vision system for the self-driving car, which exited very successfully to General Motors. Perfect Market, a provider of digital publishing software for premium publishers. OE Waves, a developer of novel microwave photonics technologies. And NetEffect, an online consumer support SaaS company. So she's done everything from the hardcore engineering to the consumer side to the SaaS side. Julie has a bachelor's in engineering from Tufts University and an MBA from Harvard Business School. Please join me in welcoming Julie Schoenfeld. Let's stand. And we got to figure out how to switch it around. I want to make sure that should be on.
So good morning, everyone. Can you hear me? So thank you for that kind introduction. When you do as many startups as I have done, first of all, you wonder if you're sane. But secondly, you get to a point where you think, who could I help with all the knowledge I gained over all these years? And so that's what I do at Caltech. I work with students, and I try to help them not make the mistakes that I made. And I just had one of the greatest moments. If you don't mind me, let me share a little story from this morning. When my son Nicholas was in kindergarten, he had a friend, and during recess, they would all go out into the playground and play dodgeball and kickball. But my son Nick and his friend Nikki, who's in the room right now, would go underneath the jungle gym, and they would sit there and say, let's come up with some company ideas. I am not kidding. This actually happened. And I was out today getting coffee just before this talk was going to get going. And who walked up to me, tapped me on the shoulder, but Nicky Demetriitis, and he has just started a medical device company. And he's in the room. So little did I know that maybe from that early beginning that this is where I would wind up in my career. And we wish you great success on your journey. Also, if I can embarrass my son Alex, who is also an entrepreneur and has started a company called Comet Communications. So I'm just awash in people starting companies. So it's fantastic. So you probably think I'm here to tell you, okay, you have an idea, you have some IP, how do you create a company out of that? And I will tell you that, but that's not how you create a company. So what I want to give you is sort of like some of the major points of what you need to do. So this is a Harvard Business School Review published study of over 800 venture capitalists. And the study asked them, what is the number one thing that is the major reason why you invest in a company? The number one reason why you invest in a company. And the dark line is physical science, and the green line is life science. And so this is, the study is, I put a link to it here. It's pretty detailed. But what do you notice? Number one thing is the team. It's not the license agreement. It's not the product. It's not the technology. It's not the market. It's the team. And so I just want to point that out, that the license agreement is like 1 minute on the day before the money launches into your company. The team takes all your time, every day, all day. So when you're starting a new business from scratch, you need two things. You need a technical expert, and you need an entrepreneur or a CEO or the person that's actually going to make things work. And scientific people, science domains, not all of them are meant to be entrepreneurs, and not all entrepreneurs can be in science. But you're looking for the sweet spot of somebody that can bring this technology to market, and you're looking for a set of skills. And so when you put your teams together, you want to make sure you have that overlap there. And if you don't, you need to think about it. So if you're going to start a company and you're 3 PhDs and a dog, my advice is, okay, you've got your idea, you've got your IP. The first thing that I encourage teams to do is to sit down and create a founder's agreement. And I didn't do this for my first 2 companies, and it bit me. I have a founder's agreement. I can send it to you. It's not a real legal agreement. It is a discussion guide for you and your fellow entrepreneurs to have, so that when things change, you're not surprised. So I'll tell you 2 quick anecdotes in my life. My first company, one of my co-founders, who I didn't know very well, he had a gambling problem, and he was the CFO. we got our money in from Greylock, and he accidentally wrote himself 2 checks for $35,000 one weekend. We owed him 35, but not 70. And had I sat down and had this deep discussion about why are you doing this, what are you all about, maybe I would have presented a lot of heartache that occurred in that first experience. My second experience was that I had a CTO, and we went out and we raised money, and we got the first check in the bank, and the day the money went into the bank, my CTO came to me and said, and we were 50-50 in this deal, I am going to go off and start my own company. And I said, okay, glad you told me. And I said, well, then you need to give me your share of the equity back. And he said, no. And I was like, are you kidding me? So had we ultimately we worked it out, but had we sat down in advance and gone through this questionnaire, none of these problems would have hit me, and the conflict that arises when people don't feel like they're treated fairly is avoided. So what's in a founder's agreement? The first part of it is the goals. Why are you doing this? Why are each one of you doing this? And I've taken entrepreneurs through this exercise. We take a whole afternoon, we go off into someplace quiet, and I take notes and I write it down. And it's just memorializing the conversation so that later on, when things are tough, you pull this back out and say, hey, you're not living up to what you said you would do. And nobody can deny that. So why are each of you doing this? Are you in alignment? Okay? Is one person doing it because they've done this research and they just want to see it into the world, and the other person is looking for a quick hit, sell the company, or is the other one, I can't get a job, so I just might as well do this? You really want to know that you are aligned. The second thing, and this is the one that I have seen deals break apart, is the ownership structure. It's the equity split. And I'm going to talk about this a little bit more in the future. The equity split causes more heartache than I've ever seen, and especially with people who invent the product but don't want to bring it to market. Because where the entrepreneur and the scientist clash is that the entrepreneur does all the hard work of getting the company off the ground, but the scientist brings all the knowledge. So how do you allocate who did what in that equation? It's not a pretty thing when people don't agree on this point. The third thing, and believe it or not, I see it every day, roles and responsibilities. 3 people will come to my office with their dog, and I'll say, okay, who's the CEO? It ain't the dog. And they look at each other, I don't know, you want to be CEO? This has to be defined or you shouldn't be doing a company. Because first of all, when you go to pitch to a VC, they want to know who's in charge. They want to know who's the one that's going to be getting the ball over the line. And roles and responsibilities have to be written out and agreed to in advance, because it's another one of those things that it causes all kinds of heartache. If you get the company going and you got the CEO as the one-armed paper hanger, and the technical person shows up 2 hours a week and spouts brilliance and then walks away. So that's a really, really important element of a founder's agreement. The next one is employment investing. When people start companies, some of them plan, oh, okay, I'm going to work 20 hours a week. We need to know what is the commitment. And so venture capitalists want you there full time. They do not want a part-time CEO. They do not want a part-time founder. And it's very, very important that you understand who's going to do what. Venture capitalists will also tend to insist on vesting. Even though you've started the company and you might own half the company, you want to say that if you leave, you don't get the stock, because they need you there. Without you, the company won't make it, especially in the early stages. So vesting is important, and looking around the room in this founders agreement, you all have to agree, yes, I'm willing to be vested. I'm willing to stay 4 years. I'm willing to do this. And finally, decision-making and dispute resolution. When you have 3 PhDs or even 2 PhDs and you've been collegial in your laboratories, and then you come out and you try to start a company and you have a disagreement, it isn't like a university where you just kind of grumble and keep on going. You actually have to resolve these disputes quickly, or else the company can become toxic. And so what you want to do is to say, okay, if if I want it one way, you want it another way, how do we split it in half? And you have that discussion now, before you get into the disagreement, and you can pull out the piece of paper. Now, when a team's working well, these issues, you never pull this thing out of the drawer because you understand it, you talk through it, and it works. When the team starts to fail, okay, you're pulling this out of the drawer. Then as the CEO, you've got to worry because you have a problem, and a team that doesn't work well like this won't be able to execute. So my advice, if you're going to start a company, first thing to do is sit down with your co-founders and work through this founders agreement. Document it, put it in the drawer, everybody has a copy, everybody agrees to the same thing, and if anything happens later on, pull it out of the drawer. Now, I talked about the problem of equity split, and this is where there are even people in this room who know who I'm talking about, who have seen this issue. This is a slide I got from Osage University Partners. They specialize in investing in university research companies, and they built this chart based on hundreds of companies that they have seen. This is typically the split you see in a pre-seed, early stage startup. And where you get, and again, I think you all will get copies of these slides, but I get, of any question that I get in my role at Caltech, this is the question I get every single time. Well, what kind of stock should I be asking for? And what's really difficult, sometimes with physical science versus life science, the splits are kind of different because with life science, the product is extremely important. But what can be very difficult is the passive founding scientist. It could be a professor, it could be the person who's still on campus, but because it's their brilliance that created the technology, they think they should have 80% of the company. And it's just not appropriate, nor is it sustainable, because a venture capitalist will not invest in a company where the passive founder owns the bulk of the company but it's not doing any of the work. So this is if you take away one slide from my talk today, take away this one. This is the kind of breakdown that you need to have if you are thinking about doing a startup spinning out of a university. If you do the split correctly, then you should have a pretty clean cap table. And what you should be thinking about is that the initial CEO and lead founders own a big chunk at the beginning, 40%. That co-founders and other key employees and investors will typically get 40%. And then 20% should be set aside for future employees. So this is the kind of cap table you should be looking for. So now you have your team together, you're all on the same page, you go out, you have cocktails on Friday, everything's cool. Now what should you do? So the first thing I say is, what problem are you trying to solve? I have people that come, again, my life is seeing incredible research and trying to decide, should we turn this into a company? And I see a lot of hammers looking for nails. I see a lot of really, really cool technology, but I don't know what problem it's solving. So the first thing you have to ask yourself if you're building a company after you've done your founders agreement is, what problem are we trying to solve? And rather than lead with the technology when you try to present this to a venture capitalist or anybody, even somebody that you're hiring, lead with the problem that you're trying to solve. I sold a company to General Motors. The problem we were trying to solve was that LiDAR systems were not good enough. The ones that were on the market today were not good enough to quickly make a decision about when the car should turn or not turn. So it was a safety-related case. They actually wrote about it one summer in the Wall Street Journal, that LiDAR was holding back the self-driving car. That's the problem I led with. I didn't lead with the fact that I had the most world-famous, advanced, coherent LiDAR technology on the planet. I led with the fact that if you wanted to do a left turn and a car was coming too fast down the road, you couldn't do it quickly enough because of the speed of the car coming at you. You would wind up in a crash. Lead with the problem, not with the technology. The thing is this a problem that really needs to be solved? Here at Caltech, I have seen some of the most extraordinary technology. I've seen technology that can do things that are 100 times better than what can be done today. But at the end of the day, what if nobody cares? What if the market problem you're trying to solve doesn't need 10 times better technology or better performance? You want to make sure, number one, the problem you're solving matters, and that the market you're bringing it into is large enough and willing to accept what you're bringing to the market. So I encourage you, if you're going to start a new company, is to craft a problem statement as the starting point and say, the problem I'm going to solve is ... And this is, known as your old elevator pitch, but also, given where we are here in the heart of Caltech, you're likely to say, I have created the most advanced LiDAR system on the planet. No, I am solving the problem of the self-driving car. So now you've got your problem statement. You are a team that's in alignment. Everyone knows they're staying for 4 years. They know their stock split. Why are you going to solve this problem better than anybody else? You've got your problem statement, and this is where you need sales skills. This is where if you're looking at each other and trying to decide who's going to be the CEO, if any one of them has sales skills, that's the CEO probably. Because you're trying to convince the people that are writing checks why you're going to solve the problem better than anybody else. And this is generally a combination of technology, but it's also a combination of your ability to explain why. At this point, and this is the part with calling on venture capitalists, and for that LiDAR company, I called on 120 VCs at the time. And at the end of the day, when I finally got my term sheet, it was kind of a slumpy time. Every 119 of those meetings, I didn't get the ball over the line. I didn't sell it. I sold it on 120. It's a numbers game. It's a tough game, but recognize that you are telling a story and selling. So investors are looking at early stage companies. You are at the highest risk point of the startup journey. This is the highest risk point, and therefore the people that invest at this point expect to be able to get a big chunk of the company because they're taking all the risk. And what you're trying to do is to try to overcome the objections. They know it's risky, and they're going to look at your story and say, here are the risks. And so what you need to do is look at yourself and figure out, what are our superpowers? Do you have incredible technical expertise? The answer here, where I'm standing, is probably yes. You probably do. But do you also have unquestioned domain expertise? If you're trying to sell into the industrial robotics market and all you know about is drones, you have a mismatch in expertise. So you want to make sure that somebody on your team understands the market well enough to be able to talk as an expert for the market you're selling into. VCs and investors love multi-company founders. So once you've had one company and it's been successful, they're very much more likely to write you a check. So if you're looking for a partner and you see somebody who's done a company before, that's always a good chance. Believe it or not, they also love unsuccessful multi-company founders because, and this I can guarantee you is true, you learn much more from your failures than you do from your successes. So multi-company founders are a great thing. Ironclad IP with proof points is also a great way to reduce the risk and demonstrated execution. But remember, I said the team matters. These are the things that the team will overcome if you get the job done. Even if you're not ready to raise money, I encourage people to create an investment deck, because the investment deck forces the discipline to make you sit through all of the questions that you will ultimately be asked about why you're doing this. And these are the elements of an investment deck that I think need to be there. And most of the templates, if you Google a precede investment template, they'll all lead with what problem are you trying to solve. Me, I always lead with the team, unless your team is weak. But I just told you that they're making the decision on the team, so why not start out by telling them how great the team is? So I always lead with the team, and then I go with what problem are you solving, and why will you solve it better? Now, the next point is why now? And the why now is that puts the urgency. Why are you doing it now? And why? Because time is also a variable. It's not just the technology is great, you're solving the problem, but it has to be done now, and this is why people will invest in it. The market. People want a large and growing market. If it's a $100 million market, you do not want venture money. You probably want to make it an SBIR company. It's just not the type of return that an investor is going to get if the market is not large enough. Competition. You got to put that in there, because if you're not out there looking at your competition, then you're blindsided. Finally, all the way down to number 7 before you actually talk about your technology. So again, you are setting a stage, you are telling a story, you are getting everyone excited about it has to be now, the market is big and growing, and now here's the product. And then finally, the business model, the funding milestones. People want to know, what are you going to do with the money? So they want you to have 18 months worth of capital to get to the next funding milestone. So if it is to get one customer, if it is to build one prototype, if it's to build 5 prototypes, can you do that credibly in 18 months to the point where then someone's willing to write you another check and the value of your company has increased? So the issue is, even though you're not ready necessarily, by doing this, you're really going to clarify a lot of things. As the CEO of startups, one of the things I always found was most difficult is that on any given day, you're being bombarded with 50, 100 problems. And one of the skills you have to learn as a CEO of a startup is, what do I work on next? Because you can't work on every problem. What do I work on next? And putting together decks like this can make it very clarifying for you to figure out what to do next. Oh, and then I promised, because Lynn asked me to talk about how do I license the technology, and I'm just like, well, that's an interesting point, but I think the other stuff is really what I think is most important to focus on. But let's talk about licensing the technology. I work over there at Caltech Hall. I put it on there for you. 6th floor. It's the Office of Technology Transfer and Corporate Partnerships. If you create IP at Caltech, you will have a licensing associate. I've listed them over there. It will be assigned to your lab or your professor or your technology. And these are some of the people. You also have Jay Chang, who's the life sciences EIR, and I am the physical sciences EIR. And what we do is we work with you. If you're at Caltech, we help you put that business plan together. I have walked people through multiple founder agreements, mostly because when I see people dodging the hard questions, I sort of make them revisit and answer those questions. And we will help you do this. And so if you want to start a company, the first thing you want is to get an option agreement from your licensing associate. And what this does is it's a placeholder for you for a year. And it allows you the time to build that business model, to build that investment deck, to figure out if you have a company worth creating. And from there, you can then roll that into a licensing agreement. So it's just like a placeholder. And it's a way of not having to spend any money or intellectual capital, get your company off the ground, and then come back later. Once you strike the licensing agreement, Caltech will expect a certain percentage of the stock, a small amount of equity, and a royalty. And someone's going to raise their hand and go, how much stock? How much? It definitely varies based on the company's business model, because royalty doesn't make sense in certain kinds of situations. So what I will say is, this is a very founder-friendly office. If you've ever worked here at Caltech, you know that. And if they're not founder-friendly, call me, and I will make sure that things start to move. We also have a lot of resources here at Caltech. So we have the Entrepreneur in Residence Guide. I work with people that are founding companies. There are people in this room who I have helped get companies off the ground, and I am just delighted to have one of them on our panel here today, one of the great entrepreneurs. We also have capital. So we have the Caltech Seed Fund, which is a $10 million pre-seed fund that Jay Chang and I make the decisions about. We get approval, of course. And we also have a co-investment fund that's not exactly part of Caltech, but it's obligated to invest in 75% of the deals. So our fund is $10 million, their fund is $40 million, and so that gives us about $50 million to deploy in pre-seed money. So getting startups off the ground here at Caltech has never been, I won't say easier because easy is relative, but we're here to help. We also have internships. I'm delighted to say I have some interns in the audience. What we do is, if you're an undergrad, We try to pair you up with an entrepreneur or a professor who's trying to do a startup and give you a really cool job for the summer where you get to either be on the entrepreneurial staff, be on the staff of the startup, or do the research, or build the investment deck, or do whatever the CEO needs you to do. And it's been super successful. In fact, Alex, who's on our panel, we've given 2 interns to his company, and one of them is the CTO to this day. So that's a hit. We also have an incubator. I don't know if you know about it. It's called Caltech Innovation Center, Building 15. We will let you have office space at a very discounted rate with other startup companies. It's not fancy. It's not like Idea Lab or some of these fancy incubators, but it's a place where a lot of entrepreneurs go, and we tend to have a monthly lunch there so everybody can do a meetup. We also have other money because sometimes you're not ready for pre-seed funding. You maybe need gift money or government money, and I think we're going to hear more about other sources of money. But we have 2 kinds of funding when your research is a little too early. It's called the grub stake, which is to try to do some of the market research, and RI squared funding, which is the Rothenberg Innovation Fund. That is a couple of $100,000 to get your idea off the ground over 2 years. This year we held the first of 3 Bill Gross business plan competitions. We just had it. It was incredibly successful. Bill, if you know Bill Gross, who is one of the leading entrepreneurs in the world, I would say, he wanted us to have 80 startups enter into this competition. And when he said that, I was like, we don't even have, this in any undergraduate class is 900 students. How are you going to get 80 startups? We got 82 applications. We narrowed it down to 16 companies, and I have been a judge all across LA. I have been a judge for UCLA, USC. I've been a judge for the Entrepreneur in Residence. I have to say I have never seen 16 deeper companies than the ones that were selected. It made me realize what an amazing place Caltech is and what should be coming out of this institution because of the amount of technology that's there. So we did. And incredible thing is that Bill Gross gave every finalist $10,000, which was great, and the winner got $30,000. We also have favorable licensing options or licensing terms. Our office has this down to a science. We try to make it smooth, painless, and frictionless. And finally, we want to make connections for you in the area. And we have placed CEOs in companies. We have found talent. We have found incredible resources, legal resources, fractional CFOs, fractional HR people, things you need to get a company off the ground. So that's it. I'm going to be... happy to take questions on the panel and happy to meet with any of you in my office if you are thinking about doing a startup. It's the thing I love the most in the world professionally to do. Thank you.
Thank you so much, Julie. And now you can see how the environment has certainly changed quite a bit at Caltech for entrepreneurship, and the fact that, as she said, it got 82 applicants out of 800 undergrads. But it's great to hear how things are happening here at Caltech. And now we're going to hear a little bit about both what is happening at USC and as well as nationally, some other funding vehicles that are available. So our next keynote speaker is Dr. Andrea Belz. She is the Vice Dean of Transformative Initiatives at USC Viterbi School of Engineering, Research Director at the Informational Sciences Institute, Director of the Center for Research in Space Technologies, and Professor of Practice in Industrial and Systems Engineering, where she specializes in engineering and policy and strategy. Andrea previously served as the Division Director of the National Science Foundation. They write a few checks. Where she oversaw the agency's principal applied research activities and the launch of the Translational Impacts Division in the new Directorate for Technology, Innovation, and Partnerships. In addition to overseeing the prestigious Small Business Innovation Research, or SBIR, and Small Business Technology Transfer, or STIR programs. Andrea previously served as the inaugural Vice Dean of Technology, Innovation, and Entrepreneurship at USC Viterbi. She operationalized the Viterbi Venture Fund in making the school's first investments into startups when she invested in a company called Relativity Space, which has done rather well. She also reimagined the Viterbi Startup Garage and developed it into a leading incubator in Los Angeles, and created the Innovation Node Los Angeles, or INLA, a regional center of excellence in the National Science Foundation I-Corps program. She holds a PhD in experimental nuclear physics from Caltech, a bachelor in physics from the University of Maryland at College Park. Please join me in welcoming Dr. Andrea Belz.
Real quick, anyone who is parked on the street here, the security from the campus has told us, please move into the parking lot underneath the athletic field, otherwise they might give you a ticket. And we'd hate for that to be your leaving thoughts of the program today. So any of you who are parked on the street here, if you could move your cars into the parking lot underneath, it's all free, but they don't want us parking here because it's a fire zone.
I'm glad I didn't park
Fire
there.
truck zone, not fire.
Can you hear me? Okay. Thank you so much for having me here today. I was not going to start with this story, but then I heard Julie's story, so I had to bring one up. Also, that in my house, there was a conversation with a 10-year-old a few years ago who said to me, Mom, if the CEO hires and fires everybody, who fires the CEO? And I thought, oh my God, that's one of my favorite questions. And so it was your typical corporate governance discussion with a 10-year-old. So that 10-year-old is now 15, and after I said to him, you don't have to major in science. You've never seen so much relief on a child's face. He announced that he was interested in all kinds of businesses. So Stephen is sitting over here right now. Please go and say hello to him if you have a chance. So I have... rather than talk about programs that we have at USC, what I'm going to do is talk a little bit instead about what really motivates the interest in technology startups in Washington. You heard that I spent 3 years there, and those 3 years encompassed the beginning of the pandemic and a lot of changes in DC. So I'll talk about that a little bit. Then I'll talk about the funding environment for deep tech startups, which I think is very relevant to our entrepreneurs here. We saw some data already about what's happening in the venture world. And then just some ideas, because if there's one thing that's true both in Washington and in the venture world, it's that there are never enough big ideas. And so I want to give you a little bit of food for thought. So the first thing I want to talk about is just the idea that translational science has been considered as an underpinning of U.S. strategy basically since the end of World War II. And the foundation came from a document that was written by Vannevar Bush, who had founded Raytheon, I believe, and had written an important document called Science, the Endless Frontier, talking about the power of science to support the nation's strategies. It also became clear in the last decade that new companies create new jobs. And while the details of this eye chart may not be clear, the red line on the top is younger companies and the blue line is older ones, whereas on the right you see them differentiated by size. And so many years ago we thought, well, it's small companies that drive the economy and economic growth. In fact, it's young companies. And so that has really begun to take a lot of attention or has called for a lot of attention in Washington. This is the problem, though. The number of startups has really been declining over decades, which is interesting for those of us who've been around universities and have seen all the excitement about startups. And yet, even with all the recent excitement, which really dates back to the founding of Facebook, and before that, there was less interest in university startups, but more interest in startups in general. This is stunning and has continued actually since 2020. So startups have been declining, but they drive economic growth. This is an interesting slide to contemplate. It's from research done at Harvard. And if you look at the big gray box on the left, that represents telecom, computer hardware, energy, what we now think of as the underpinnings of deep technology. And the left-hand bar is in the 80s, the right-hand bar is today, or at least in the last decade, and you can see the light blue. I wonder if my laser pointer works. Oh, goodness, it does. Okay, so the light blue is consumer products. You can see that that's basically eaten up the slice that used to be taken by hardware. And it's interesting, some of you may know Dave Eastman, who's sitting in the corner and runs the Viterbi Venture Fund and the Viterbi Startup Garage. We did a Caltech spinoff many years ago that had an interesting technology for lasers. And it originally was founded in the first dot-com boom. I'll show you some data around that. It's interesting to think about whether that company could even raise money today. And Dave, if you don't see him, he's shaking his head no. It's fascinating to think about the tiny slice that hardware now has in the venture world in general. And consumer products have basically displaced hardware. And there's additional work that my team has done in looking at how engineering firms are penalized even in connection to life sciences. So we'll take another look at some of those dynamics. Intellectual property is really important on the national scale. The left-hand chart, or the left-hand table of numbers, shows you several metrics relevant to IP-intensive industries, and the right is non-IP industries. And what we know is that wages are higher in companies that have strong intellectual property portfolios, even if those jobs are not working on IP. So another way to say that is that a secretary in a tech company will do better than a secretary in a construction company. And so for this reason, IP-rich companies are very important in the national fabric. Here's another view of it, which is that an estimated 30% of the NASDAQ's value comes from university-funded research, which is a pretty big number. And this chart is based on data from Ocean Tomo. Some of you may know this is an investment bank, and I don't know if these shaded areas are very clear. But here's what this chart tells you. In 1975, this chart, 100% is all the market value of the S&P 500. And at the bottom, you see 17% was captured in intangible assets, which includes IP. The bulk of the market value was tangible assets, property, plants, equipment, et cetera. And 40 years later, that ratio had reversed. In other words, most of the market value of the S&P 500 is represented by intangible assets. Now, that's not just patents, that's intellectual property of all types. It's goodwill and brands, et cetera. But regardless, what you see is that oh, I guess you do see it, okay. that most of the market value is really, the market value today represents intangible assets. So IP is really important. So I know I have flown through some data. I have a little bit more to show you. This is a study that I did for the National Academies a few years ago. And we asked the question, who does publicly funded R&D at different stages? On the left, you see what universities do. And universities, of course, are the biggest, their biggest type of research, character of research, is basic research. That's the blue line. The red is applied, and then the green is the most advanced, which is development funding. On the right, you see what industry does. So industry does mostly development funding, which obviously has had some economic cycles, and some applied research, less basic research. What's interesting about this chart is that the y-axis is the same for the universities and for industry. And so this red line, which is the applied research, is really about the same size. What that tells you is that the public funding goes toward basic research in universities, development funding in industry, and somehow there's supposed to be a handoff between these. Are we very good at this as a nation? I don't know. I think Julie's story about finding 80 applicants is really interesting. When I taught here at Caltech, I had a class that went from 20 to 40 students, and of course that's a large fraction of the undergraduate and graduate populations here. Oh, it doubled. It's a couple % of all the students. So 80 is really a lot. Do we necessarily, do we hand those off very well? I don't know that we do yet as a nation, and it's important that we do so. I should also say that these numbers represent just the public funding. Another big trend in the nation as a whole is the fact that industry now spends twice as much on R&D as the federal government. And so some of us who have been around a while remember the end of the Cold War, and that changed the trends of a lot of the research funding in the United States. So industry is funding research, which means that industry sources of research funding are really important as you start growing your companies as well. So what's the net of all of this? If you look at what we've seen several components here to the national ecosystem. First of all, young companies create jobs. That is of paramount importance, obviously, in Washington, and the number of startups has flattened or is declining. We know how venture capital has changed, and companies that were funded 20 years ago, probably funded by some of us sitting in this room, would really have a hard time raising money today. We know that intellectual property is very important, not just on a firm-by-firm level, but on the national scale. It contributes to the stock market and contributes to job earnings. And then finally, this idea that universities, which are in many cases the wellspring of a lot of key technologies that underpin the products of the future. Some of you may remember the beginning of the pandemic, and when the vaccines came out, that was something you would talk about at outdoor cocktail parties, right? Which vaccine did you get? One of them was based on research that had been done at MIT. So when you start capturing all of these, what you discover is that it's a really good idea for government to invest in technology startups. And these dynamics are what underpin some of the interest in Washington in programs like SBIR and STTR. I oversaw the programs at NSF for several years. I don't speak for NSF today, but I can say that this is certainly some of the motivation around what's happening in Washington. I want to talk just a little bit about what's happening in the capital markets. I know that everyone is probably aware it's harder to raise money than it was a couple of years ago. And there are lots of great data out there. I didn't want to keep showering you with data. Actually, I did want to keep showering you with data, but I was warned about how much time I would have. Evidently, you're not all my students in my class, so I'll try to focus that way. 10 years of venture funding, and what we see, obviously, is this peak a couple of years ago. It's like it's a photogenic slide. Suddenly, I feel like everyone has suddenly seen a Kardashian in a restaurant, all these cameras coming out. But what you can see is that over a period of 7 or 8 years, the green line is the number of deals, and the blue is the total dollars invested. And so what you see is that the volume may be increased by 1/3 from the trough to the peak, but the dollars increased went up by 3x. So what that means is that's investors putting a lot of cash to work, because over these years, for many reasons, one of which was that the interest rates, of course, were very low during this time, and so that there was really there were fewer places in which to put cash. And so this is just a representation of what I think we're all aware of, which is that this peak was a couple of years ago, and it was really incredible during that time. I did not include a chart that I have, and I knew I was going to regret it. There's a chart that shows how the number of down rounds has changed over time. And so what you see is that, I wish I had the chart. Over here, the percentage of financing rounds that were down rounds is something like 6% in 2021 and maybe 20% in 2023. So I think we can all say, ouch, that would hurt. This is another view of the venture capital flight from hardware to software. This orange line here is internet and software investments, but primarily internet. And so this is the dot-com boom. You can see the fall and then the general recovery over the decades that followed. And of course, this went up after 2018. The blue here is healthcare, which was not as strongly impacted by the dot-com boom. And it had some fits and starts, and of course really started to grow in this time after 2018. The red and the black lines are electronics and industrial technologies, respectively. And what you see is that they never really recovered from the dot-com boom. There was a little bit of activity, if we were to segment this further, there was some activity here in green technologies in 2008, 9, and 10. But for the most part, they really never came back. And so those of us who are interested in deep tech, and I apologize for not having more recent data. This is from the PricewaterhouseCoopers survey, which changed hands, and I was not able to get the data as easily as I used to. One reason this is important is that while angel and venture groups both contribute to innovation, VC-funded ventures are commercialized faster. And so I loved Julie's story about 119 investors saying no, and 120 said yes. Those ventures, getting that kind of funding makes an enormous difference on the success later. Very few ventures are able to really grow all the way to exit without getting some venture money along the way. So for those of you who think, I'll do it alone, I don't need those VCs, you might. This is a recent chart from 2023 that tells us about venture capital funding by sector. And so what we see here is the black lines are seed funding and the red are Series A. This big peak here is healthcare funding at Series A. And you can see AI, of course, there's tremendous interest, biotechnology, IT, and medical. And then there are a number of additional technologies here, fintech, genetics, blockchain, that have gotten a little bit less interest, but there is still funding going into these various sectors. This is an analysis of how deep tech does. And what's interesting about this, going back to the question of would a company funded 20 years ago be funded today? 20 years ago, the kinds of conversations that used to happen were things like, oh my gosh, it's a software company, so if it fails, there's nothing left over. At least if we make things, we have something that we can then sell or liquidate. And so 20 years ago, it was considered less risky to invest in hardware. Today, if you tried to make that argument, I actually hear people laughing over here at that argument. So the sense has really changed on that front. Another interesting factor that's happening is some of you may be familiar with the CHIPS and Science Act and the funding, I see some nodding, some funding that's been going into semiconductor manufacturing and development. And we're fortunate at USC, we run a consortium called California Dreams, which stands for Defense Ready Electronics and Micro Devices Super Hub. And since this is getting recorded, I will say I came up with the acronym. The Caltech is, of course, one of the members of our Super Hub, as are most of the major research universities in Southern California. And it's intended to develop semiconductor technologies, particularly for the defense enterprise. And we work with many of the defense leaders that you know, Northrop Grumman, Lockheed Martin, Teledyne, in order to bring these technologies to market. Here's what's interesting about it. When I first got to Washington and I was talking with a congressional staffer, he said, how do you decide what kind of companies to fund in SBIR and STTR? And I said, we fund the best of what comes in. And NSF is a PI-driven organization and funding strategy. And he said, well, good, because if you decided ahead of time what sectors to fund, that would be industrial policy. And we don't do that in the United States. I said, Roger. And then 2 years later, the CHIPS and Science Act was passed, which allocated $52 billion to the semiconductor industry. So things change, I think, is one lesson to take out of this. And the second is that there is now new interest, certainly in those technologies. The Department of Defense has built a new Office of Strategic Capital that has resources, particularly for venture funds who are interested in technologies that are addressing the national interest and national security concerns. So this tells you that deep tech delivers good returns, but you might have to wait a while. This analysis is that it's 95 months, which is the same as 8 years, to go from seed to Series D for deep tech startups versus a couple of years less for other tech startups. And again, I'm going to quote the the guru Dave Eastman. When we sold this Caltech spinoff, the company was 19 years old. And as he said, well, the company is old enough to vote. Let's sell it before it's old enough to drink. And we thought that was a pretty good idea. So this is really not for the faint of heart, right? When you talk about being in and out and are you committed for 4 years, I mean, let's light some incense that it's only 4 years. Okay. The last thing I want to talk about is just some general ideas on the kinds of technologies that are coming. And I say this because I know there are many entrepreneurs here. You've all got your own technologies that you're working on. I also really loved the story about LiDAR, and that you start with LiDAR systems are not good enough, not this is my LiDAR system. So these are just some ideas of the kinds of things that are coming, and that we as investors and as entrepreneurs, we can look for some of these opportunities. So one is the idea of what I think of as digital neurology, and that our nervous system basically has so many opportunities and inspirations for interesting systems. For instance, we talk about edge computing and how important it is, for instance, in LiDAR systems for cars. And wouldn't it be great if you could do some processing on board before you have to send these signals back, because there's not enough time for that. And it's not that there's no model for that. What we call that in the body is the reflex system, right? We know what systems look like where you do a little bit of fast processing in advance. So what else could we learn? We could probably learn about technologies that do sensory replication. Here at Caltech, there was an effort for an electronic nose and an electronic tongue many years ago. Many of those technologies are still being developed and I think have great opportunities. A second one is the idea of understanding interactions. There's a lot of new effort now on human-computer interactions that are much more sophisticated than just, does this user interface look friendly? We read from left to right. Is the information presented that way? The truth is that when we interact, we have a whole lot of metadata that comes up. When I have the pleasure of interacting with Leon Alcalay here, who is going to come up in another slide later, I remember the last time that we talked, and I remember that he was looking at working with different countries on their space portfolios. There was an estimate 10 years ago or 5 years ago that there is something like 10 times more metadata in the cloud than there are data. The idea of data about data is really important and probably has a lot to teach us about how we think about our interactions and how we can build better systems that operate between humans or between humans and computers. And then the idea of transforming this into artificial intuition. This is something that I have been spending a lot of time thinking about, which is if we think of artificial intelligence as basically conducting large-scale statistical analyses of words, for instance, or other signals, the truth is that some words are much more important than others when we interact. Some signals are much more important. Like when I talk to Leon again, he says many wonderful things, but the word space is really important when we talk. And so the idea that when he says space, I hear all kinds of other things. I think about thermal systems, and I think about communications, and I think about electronic warfare and all these other things that are happening. How do we transform metadata into systems that do some thinking that is not strictly statistical in nature? I think all of these will give us many interesting companies to come. I think there's still a lot happening on many of the processes that control materials or substances at the molecular level. Energy storage, generation, conversion, all of these technologies will continue to be important for us. If you've ever heard Lee Hood talk, he talks about personalized and predictive and preventative medicine. That will continue to happen. We still don't know why some people have long COVID and some people don't. Why do we don't understand? There are many examples of different diseases, disorders, why people are in good health when they eat raisin rolls every morning. I hope that that is true. You know, why we don't understand a lot about health at the individual level. And then, of course, everything having to do with materials science, we will continue to see very interesting materials be developed. Everything on the human-computer physical teaming, I think of this as atoms, bits, and cells. We are going to continue to see many new systems be developed for smart cities, smart machinery, machinery that repairs itself, a lot of the diagnostics in mines and factories. That will continue to be a source of interesting economic opportunities. And human-machine decision systems, I think this is going to bear fruit for a long time. There are obviously some systems where you will want a human in the loop and some where you don't have time to have a human in the loop. That's one of the challenges of automatic cars, right? The automatic autonomous driving. When do you want someone to be involved in the decision making, and when don't you? And of course, this happens on a much larger scale in military activities, in many distributed manufacturing activities. And then finally, I think threat detection is going to continue to be important. Many of us have seen the geopolitical landscape change dramatically in the last couple of years, and so being able to mitigate threats of different kinds will be very important and will probably be a source of interesting business opportunities. So, in general, number one, technology startups, especially coming from universities, offer significant economic promise on the national scale and, of course, on a regional scale as well. We're so fortunate to be here in LA. I liked seeing the statistics on how LA is doing in terms of attracting venture capital. Many of us have seen that change and have been part of that change. Second is, I think I don't need to tell you, the venture market has changed a lot in the last couple of years. For instance, you no longer trip over bags of money as you walk around. And so it's going to take a lot of patience for those of us interested in technology startups. And then finally, the digital transformation of industries is still just starting. When the internet began, I think if you had said, it's going to change the taxi industry, people would say, a quizzical dog look. I got in a cab the other day. I was coming back from LAX, and the cab driver was explaining to me that he thinks cabs will be gone in a couple more years, and it will only be Uber, which is an interesting thing to think about. Certainly, I think Uber has changed LA. So I just wanted to thank you for your time and attention. I'm happy to talk about USC programs in general, but I think that really understanding the large picture is important to us. So, thank you. Of course, we'll watch the cartoon for another minute also. The cartoon's almost done. It's so fun. Back to the hospital.
It starts over.
It starts over. We don't have to watch it more than once. Don't worry. Thank you.
Yeah, thanks again. My name is Len Foster. I'm the chairman of the executive committee of the Caltech Forum. So if you see the members walking around with the executive committee, Leon again, there's a lot of time and effort that's put into these events. And so, like I said, it's a group effort. Really a lot goes into it. So we're going to restart real quick. So again, the event is really focused on these very early stage startups, right? You know, the very beginning stages. Julie talking about Caltech, Andrea talking about a lot of the big picture, these kind of big arcs. If you think about the entire pharmaceutical industry, traces back to the molecular biology research of the 1950s, you know, if you really draw that line. So I can tap dance for about another 30 seconds. But I have some intro slides. We're going to call up our panel. We also have a venture capitalist and an entrepreneur that have recently gone through the funding side, going through the fundraising side, right? So we'll have all these perspectives. At the end, we're going to have Q&A, so you can ask your questions then, and then we'll have networking at the very end. So it should be. Yeah, Viraj, can you? How about that one? You asked for it. So. Yeah. So again, we will have. I have a slide at the end actually that there was a company called Honey that sold to PayPal about 2 years ago for $4 billion, and one of the committee knows the founders very well. Sent him an email of congratulations, and he said, yeah, thank you so much. I met my co-founder at the Caltech Entrepreneurs Forum that you brought me to. So about 7 years ago, those two founders were sitting in the seats you're sitting in. They talked afterward. They started a company. So please do so today. Sell your company and stand by for the invoice that you get from the Caltech Entrepreneurs Forum. So. Okay. So is that still okay on volume? Yeah. Okay. Okay, so very early stage companies, the starting point. Please, please, please. It's a good thing we're not around technology because, you know, we'd look like idiots. The other rule of producing is don't follow Andrea, right? So we've already violated one of our cardinal rules. So there we go. Okay, so again, we are going to have the. Okay, it's on. Okay, so again, we're going to have the panel discussion focused on the very early stage technologies, right? So really focus on the very, very beginning stages. You have 3 founders, you have 3 PhDs, you have 5 patents, you have brilliant technology. But what you need is that 4th person who really knows business, who knows finance, who knows marketing. What you have instead of that 4th person is a Labrador Retriever, right? So you are going to have to wear a lot of hats. You're going to have to do a lot of the finance, the business, things like that. That's what the event is focused on. So this slide, actually, if you're, this slide you can download off our website. We can also email it to you. So again, auto forward should not be on. So the typical path, if you've kind of never seen this, you have that idea, you're gonna bootstrap, you're gonna pay some of your own money, perhaps get an SBIR that pays some of the engineering cost. Then you go to, once you're kind of developing a prototype, you go to what they call friends, family, and fools. People that are investing 20 to 100K, and you as an individual, as opposed to, you know, as opposed to the company. After that, when you find product market fit, then professional investors, like she was talking about Ondax, 50 to 250K from people that are sophisticated investors or investing in the business, not you. Then you go to venture capital when you have early revenue, what they call pre-seed, right? 500K, you know, $2 million. in early revenue. Then as you have defined revenue, a very defined model, the very defined market, then you get your seed round 1 to 5 million. So again, that slide we will put out for you. So we'd like to ask the panelists to come up. So we also have an entrepreneur and a venture capitalist that are here joining us. So can you get this? Can you turn off the auto advance? Okay, the auto advance is still running. So real quickly, Alex Balactori is the co-founder and CEO of Stroke DX, a recent global winner of MedTech Innovator, and a Doctor of Medicine candidate at Keck USC School of Medicine. Yeah, it's doing the auto advance. So he's successfully raised capital for Stroke DX through venture capital and non-dilutive mechanisms. He's developed FDA-cleared products, authored over 46 manuscripts, and delivered more than 45 presentations at global conferences. Also sitting to his right, your left, Kevin Barrett is a managing partner of Free Flow Ventures. He has 30 years of experience in startup, deal making, and operating experience in roles including EIR, including executive in residence with Bain Capital Ventures and SV Life Sciences. Chief Development Officer of ProMedica Corporation, Senior Vice President of Commercial Operations at BG Medicine, and Chief Operating Officer at Synergy Informatics. More recently, Kevin was President and CEO of Altegra Health, where under his leadership, Altegra grew revenue and earnings over 400%, leading to the successful sale of the company to Change Healthcare in 2015 for over $900 million. So again, we're going to kind of go through the panel discussion, and then you'll have a chance to ask questions at the end. So I would start with Kevin and Alex. Of when you have those early stage companies, right, coming to you for the first time, really not a lot of background and stuff like that, what are you looking for? What's your advice? What do you normally see, and what do you normally have to nudge along?
I'll start. Can everybody hear me? William said that we have to eat the microphone just to make sure. So I have to hold the button down and get real close. So, I think back to one of the slides that Julie put up with results from, I think it was a Harvard Business School study. Julie and I both went to Harvard Business School, so I sort of accept it at face value. The thing that surprised me about it is that product was market was much further over to the right than I would have expected. So I agree, whether it's 3 PhDs and a dog or some other configuration, when somebody comes to us, we think first about team, then we think about product/technology and the extent to which the technology has been de-risked. Venture capitalists, at least Free Flow Ventures, the firm that I help manage, we prefer not to invest in technological or technology risk, and rather we think about taking engineering and execution risk. So the team, absolutely agree, is very, very important. Product technology is important, but market to us is actually right up there with team and product/technology, because we've heard different euphemisms and expressions about great technology that doesn't serve an unmet need. It doesn't solve an actual problem. And there's a lot of academic pride, a lot of blood, sweat, and tears that goes into developing some really sophisticated, really slick, elegant technologies, but they don't solve the problem. So if you don't have at least a notion that the total addressable market, or the TAM, as it's referred to, is at least $1 billion, then it's really not a market that we want to pursue. And if you think, it's a $100 million market, but you're going to get 80% of the market, that discussion is over, because very few companies get 80% of the market. And as we're seeing those today, from a sort of commerce and politics and policy standpoint, those that are approaching those levels are now getting hammered by the OIG, DOJ, Congress, so on and so forth. So market is absolutely critical to us. Team is absolutely critical, and then product/technology. That's really how it starts and ends for us.
Yeah, Alex?
Yeah, happy to add, just from the founder's perspective when presenting this information, also coming from the innovation, my co-founder Shane here. Shane, very quickly. developed the technology in his PhD at Caltech. When you're coming to an investor, thanks to help from Julie and that pitch deck that we saw back in 2021 and Shane even earlier, probably 2019, when you come out of your grad program and you have some innovative idea, you really need to sit down and say, okay, we have 10 different paths that we can take, right? When you bring and present this information to someone like Kevin, you need to display that, look, we have these 10 different ideas, we have this one idea that can be applied 10 different ways, which makes our market, in the multi-billion-dollar range, which is a good thing. But also what I want to say when we talk about this topic is that, especially in the early stages, you identifying, okay, we do have these 10 opportunities, but this one is the one we're going to pursue first, is a story that you need to weave throughout that deck. And it's something that we learned. It took us a little bit because we first had this amazing technology that we could apply to so many different things within neurodiagnostics that we thought was a huge positive, right? And I remember we learned quickly that, yes, there are some positive elements to saying that this is the total market that we can pursue with this technology. But really, we learned that going through this exercise that, the market for us, we needed to show that this was our clear-cut path. This is what we're going to first approach, and this is how we're going to do it. But then in the future, these are all the other things. So it's just a note that I wanted to say with respect to that.
Yeah. I think that's it. Just to quickly follow up on that. Can you hear me? Can I actually sit back in my chair? Okay, great. So that's a really very important point. You can't sort of manufacture the TAM by the total addressable market by saying you're going to go into like 7 different verticals. Just because you could conceivably do that. You need to have what we think of as a beachhead market, that you're going to focus exclusively on that market because there's customer discovery that needs to be done. You need to understand reimbursement, unit economics. There's a host of different things you need to understand about the market that you're going to enter. And so the notion that you're going to sort of spread the peanut butter really wide and that's going to get you to a sufficiently large market size, that's appropriate for a much longer-term strategic view of the business. But for a startup, you need to have a beachhead market. You need to know where you're going to start, and you need to know that that's going to generate enough interest, enough revenue, enough customers to raise the next round.
So in that beachhead, like in the slide, we referred to it as product market fit. So for Julie, like, how did you do that? How did you go through that process? Who did you talk to? What's the...
I roll my eyes because that is probably one of the hardest problems that you're going to have to face. And it's more of an art than a science, although you have to talk to a lot of customers. And you have to really, it's not enough to go buy the study that says the laser market is this big. You have to get out there and talk to the people that are using lasers and find out, and I'm using lasers as an example, lasers won't get funded. I have a comment on that. So I think the people that have done the best job finding product market fit are the ones that are willing to put in the shoe leather. And the iCore program that people talk about is you have to go out and talk to 100 customers and find out really what it is that you're looking for. And one of the reasons that Stroke DX has done such a good job is that they're in med school, they're sitting in ERs, they're looking at stroke patients, so they were so intimately involved in the customer discovery that their ability to focus their market happened a lot quicker than I've seen other startups do. So there's no shortcut. I once had a mentor who used to say, you know how I'm successful? And he'd take off his shoe and he'd hold it up and there'd be a hole in the bottom of his shoe. And he'd go, shoe leather. You just got to knock on every door. And it's the same with everything, whether you're fundraising, whether you're trying to figure out what product you're trying to solve. There's no shortage. There's no escape. There's no shortcut for knowing what you're trying to do to find the product market fit.
And I'll agree with it's more of an art than a science, and especially with respect to a TAM, there's a lot of maybe it's not the best thing to say, but financial engineering involved with the TAM assessments. But one actual recommendation that we received that helped us a lot with product market fit that actually has a methodology for going through this exercise is a book called Biodesign. Was essentially the gave us the blueprint for going through it with a methodology that is validated and also just teaches you a lot about different markets as well, not just the United States. So I highly recommend that book. It was a huge help for all of us, and everyone on our team has read it multiple times and continues to reference it to this date.
Yeah, so you mentioned some of these formal programs that if you are a postdoc and you're going through this process and that type of thing, there are programs like the NSF I-Corps that will help you with that and that type of thing. And so, if I remember correctly, Andrea invented I-Corps, so maybe you could spin to it.
Let me correct that. Can you hear me, by the way? Okay. I'm not convinced because the light's not on, but can you hear me? Perfect. So, I-Corps is an interesting idea. For those of you who aren't familiar with it, it is a structured program that basically formulates customer discovery so that you think of it as scientific hypotheses, and that you go into the marketplace with a hypothesis that cost matters more than weight, or that the time to production is the most important driver, whatever your hypothesis is. And then you go and test it by talking to people. And it was originally developed in a class at Stanford. Steve Blank was teaching this material, and it was repackaged in what was an experimental program at the National Science Foundation. This is now more than 10 years ago. And, short story, I was doing a UCLA startup, and we had space in Venice Beach because at the time it was cheap. So nobody was there yet. We had a great suite that had laboratory space, and the CEO put up a business model canvas on a wall that was probably 4 feet wide, a couple feet high, and we would scribble and put Post-it notes on it. And one day he said to me, "You know, the government is teaching this." And I said, "That's ridiculous. That will never work." And turns out that was I-Corps. About 10 years ago, we brought I-Corps to Southern California in a partnership with Caltech, UCLA, and USC. So I led that, and then I went to NSF to run it nationally. And the thesis is that you should be inquiring of the marketplace with the same rigor that you would use in your laboratory. And that missing piece, I think, has made a huge difference for deep tech startups that then go on and launch successfully. The program requires that you talk to 100 people in 7 weeks. And the really successful ones are the ones that come back in week 5 and say something like, "I don't think 100 is enough." Now, for every one of those, there are probably 3 that say, "When will this be over?" 100's a lot. So the shoe leather, though, is really, it's not a joke, and it never ends. It's when you're talking to the investors, when you're talking to potential customers, partners, doesn't matter. The most important skill is not how you develop your technology, it's how good a listener you are. And I think that's something that we don't necessarily emphasize in our technical curricula, and yet that's what's the difference with success and failure.
Can I pile on here?
Please do.
So I think this is a really important point, and when we encounter a group that's gone through the I-Corps program or found another way to do customer discovery, that really weighs heavily, positively in terms of our view. And typically, the groups that go through the I-Corps program is pre-company formation, maybe simultaneous, but usually pre. And so there is sort of a halo effect for undergraduate students, graduate students, and postdocs who can get access to customers by playing the I'm a student card, which if I were to call them, they would hang up on me as a venture capitalist, because who wants to talk to venture capitalists unless you need money from them? So, so playing that card can be really effective in it, and they literally will talk to 100 or more companies. And that's one way, to really hone in on your beachhead market, to validate your TAM, both bottoms up and top down. And so it's a really important step, and it's one that we often encounter, wannabe entrepreneurs who haven't done any of this. And so we, Free Flow Ventures, will say to them, we won't say no, but we'll just say not yet. You need to really go back, and there's more work to be done while you're still under the sort of protective cover of your university environment. Take advantage of that, get everything you can out of it, and do the work that you can do more easily as a student, because once you take venture capital, the clock is ticking. And there's no turning back. Once you take venture money, then you just need to keep going until you either fail or succeed. So doing that customer discovery, as you described, is really a very valuable step and pays great dividends down the road.
And I have one more thing to add, one more story, which is that when we first started doing a shortened and abridged version of I-Core, we did it in a biomedical lab at USC. We had several teams come in for the first day, and we talk about how do you interview a customer. I mean, that's the great thing about I-Core, is that it doesn't just demand that you do it, it teach you how to do it. So there was a team that came in, and it was 4 grad students, and they were very excited about their technology. Then they had to come back a week later and report on how they did. The next week the team comes in, and it's 2 people. And so the first thing I said, they put up their first slide, I said, wait, where's your team? Well, nobody would return our calls, and so they decided to stay in academia. I thought, wow, I mean, but the reason you have a hard time doing customer discovery is because it's hard. It's really hard to do. And so you have to stick with it. Those people, though, who stepped out of the process at that point, thank goodness that they hadn't yet taken money from someone like Kevin. That would not be a good outcome.
No, it would not.
Yeah. And the conversation didn't happen at 2 a.m. before some big deliverable and that type of thing. So, and also just one thing, Julie's being modest, but the Caltech Tech Transfer Office, Tech Transfer has only been around for about 30 years as a thing. And Caltech is absolutely one of the best. They absolutely are some of the most supportive. They have the most resources for you. So in kind of those early stages, you're kind of doing things out of your own pocket. Your credit cards are probably getting maxed out. What are the resources that you go to? What can you draw on? What can you pull from? What can you do? What can you beg, borrow, and steal? You know, anybody on the panel.
Maybe I can talk for a moment about government funding sources and the SBIR and STTR programs. So SBIR and STTR are really excellent sources of non-dilutive capital. It is a formal application process. In the different agencies run their SBIR programs very differently. So for instance, at NSF, the program officers are typically ex-entrepreneurs, and who have PhDs and have done deep tech startups, et cetera. So they're the ones who are running the selection process, whereas at something like NASA, the SBIR program officers are likely to be people who are working at NASA, who have been there for many years and understand the mission's needs. So just like we were saying a moment ago about know your customer, you should also know the agency to which you're applying, because they each have different needs and requirements. In those processes, the first phase is really there as a quick validation process. The real money is in phase 2. In different agencies, they might have other funding opportunities after that. So for instance, in DoD, they have what they call phase 3 opportunities, which is more money that follows an SBIR phase 1 as the only requirement. At NSF, there is the phase 2B supplement, which is a matching program. If you raise private capital, NSF will come in, 50 cents on the dollar, and augment your funds. So that's a nice way to add to your coffers without giving up any equity or taking on debt at the beginning.
No, when Andrea put the slide up where she showed venture capital funding over the years, she started at 2014 to now. And I was sitting there looking at the slide as an OG, and I started this in 2000. And I was like, I'm older than the slide.
Me too.
Back when I started doing this in 2000, it was there were fewer venture capitalists. There were, to get a company off the ground, you really need like $5 million, because you had to buy the computers, you had to buy the telephone system, you had to buy the Xerox. There was a far greater investment to get a company off the ground back then. Flash forward to today, you know, everybody comes with their own laptop. Nobody needs a phone. Everyone has their own phone. You can stand up a company for a couple of $100,000. And you can really make a lot of progress on a little bit of money. And on top of that, back when I started, oh my God, can you believe it? I had to walk to school with no boots on. There were like 15 VCs that mattered back in the day. And if you couldn't get those people to be interested in you, you probably weren't going to get a company off the ground. Now, every time I turn around, there's a new VC company out there. Honestly, I spent a lot of time, and I spent a lot of time with Kevin, who's a wonderful venture capitalist. But I get calls from people, actually I love the names, you know, like Blue Nile Ventures. But there's lots and lots of money for seed startups. And so I go against a little bit because I'm an entrepreneur. And I think if you really want to do it and your idea is strong, you should not let anything stand in your way. And if you can't get venture funding for whatever reason or seed funding, go get SBIR money. I learned back in the day when no one would give me a venture check, I found out that 1 in 100 companies at that time were getting venture money. Then I found out 1 in 4 were getting SBIRs. If you run one of these companies, your major job, I used to say it's my only job, is just don't run out of money. And so you just keep finding sources. Our office has money, but we don't give it to everybody. We want to make sure the idea is realistic and the team is credible.
You know, it's interesting because I think you're absolutely right that you can start a company for much less capital today. As you scale and grow your company, though, people are still expensive, and people are your best, are your most important investment. I think your team.
It's true.
And
Team is still a thing, but even back then, I had to have a full-time CFO, and I had to have a payroll system. And now you have all these shared services where you can get things for fractional, like some of these, forgive me for the lawyers in the room, some of these clerky things. You get templates that are, can get you off the ground and keep your costs low. So I think it's a lot more efficient than it was in the last, even 10 years ago.
Yeah.
Right, but this pre-seed funding, the initial point of intersection typically for a venture capital firm, now it's gotten a lot more complicated. Lynn, you put up a slide that showed, 500,000 to 2 million. So I agree, you can start a company with a lot less capital, but you're better off doing it with a grant, foundation, or other non-dilutive capital. It's generally referred to as sort of a bucket of a lot of different capital that isn't venture capital. And the reason I say that now is because if you raise $500,000, and it now takes 6 to 9 months to raise another round, that means if that $500,000, maybe that's going to last you a year, that means you're back out on the street raising money in 3 months. And you're not going to accomplish a whole lot in 3 months. You're not going to hit a value inflection point or a milestone that would then arm you to go out and raise more money. So our rule of thumb now at Free Flow Ventures is you need to raise 18 months worth of cash. And we'll be part of that, and if it's at least 18 months, then we'll consider it. That gives you about a year, maybe a little bit less than a year to do some damage, hit some milestones, achieve some value inflection points, and then that still gives you at least 6 months, which is what you need. And there's a lot of sort of unrealistic views about how quickly people will be able to raise the next round. But the facts are the facts, and it takes now 6 to 9 months to raise that next round, which would be the seed round. So with that in mind, and we've made investments in rounds going back to maybe 2020 when we made our first investment, where the round was $500,000, and that worked. But things have changed, and we saw how dynamic this whole environment has been on a lot of the graphs and the metrics that have been presented. So now it's, for us, 18 months, and I think we're probably reflective of a lot of firms in terms of how they think about it.
Well, the data support that. Again, more data that I didn't bring, but basically the time to raise in your next round has doubled over the last 5 years, and so it's no joke. You will, and by the way, you will be raising money all the time. That's just a fact. You will be raising money all the time.
Yeah, so what I can say is that as a startup, you really only have 2 things in your support tool for talking to people like Kevin. Kevin's a great one. He's one of the few good ones. That it's your accomplishments. So what milestones have you accomplished, and how much money do you have left? That's really it. There's nothing else. It's simple. So it doesn't matter if you've accomplished a ton of great things. If you have 1 month left of runway and you need money, your back's against the wall. So for us, and also from a lot of things talking with CEOs that we've met through MedTech Innovator, the 18 months is it's a little short for what we've been hearing as well. 20 to 24 is what a lot of people are telling us as well.
It's the absolute minimum.
Yeah, and for us, again, it's like Kevin was saying, it's a minimum of from the first point of contact to a VC to the time that they're willingness to write you a check is about 6 months. The bar has just been raised. The money is out there, and obviously this institution, there are incredible ideas that you should be pursuing that will be funded. But just recognize that the bar is a lot higher for across the stage, and especially for pre-commercial companies. So again, recognizing what you have done and how much money you have left after your first raise. But I guess when you look at it from if you haven't raised yet, when you're scoping out your budget, you need to really budget for what is realistic that I can accomplish in this amount of time with still having enough money so that I can negotiate for that next round. And that's where people get really stuck. And I think another big place where a lot of companies get in difficult situations on raising subsequent rounds is that, and even the first round is equity and valuation, which is something that Kevin can probably speak to a lot more than I can. Also, I could be able to speak to more than I can. But valuations are lower now, and especially when you need to be aware of that when you are presenting what you have done and what you will do. It's more important to scope out what can be done with the amount of money and where you will make it. And if you can't grasp that initially, it will be very difficult when you're talking to venture because they are going to be very harsh about it. So scoping out what you can do and making sure that you have enough runway at the end, even if it's like, oh man, we're going to lose another 5% by taking this extra $500K or $1 million. In the long run, the only thing that you should care about is the success of your company. So that's something that we have learned and seen other companies fail to do, and something that we kind of keep through our fabric, and it's proven successful for us so far.
Yeah, Kevin, could you tell the audience what a safe is and why it's so popular?
A safe?
A safe, yeah.
A safe is a thing that you put your money in.
Thank you very much.
Hope nobody takes it. A safe is a simple agreement for future equity, and it's a boilerplate agreement. It's more debt-like than it is equity-like, and what it basically allows you to do is to quickly execute a transaction. Safes are increasingly common in pre-seed and seed rounds. There are templates available from Y Combinator and NVCA, the Venture Capital Association. There's like 4 blanks on a safe that you have to fill in, and one of them is the date, and another one is your signature, and then sometimes there's a discount associated with the safe, or a post-money conversion cap, and then the amount of the safe. So it's a very simple document. The idea is nobody changes the document. You only fill in those blanks. So there's not a lot of legal review. There's not a lot of negotiation. There's not a lot of back and forth. And it's proving to be a very effective vehicle to literally kick the can down the road on valuation and just get a company up and running, get the money in to the company, and spend more time focusing on building the company, figuring out your go-to-market, your product market fit, and all the other things that are critical, to the company. But just another note before you sort of move too quickly on your comment, Alex, about valuation. So once we're invested with a company, we're in the same boat with you in terms of dilution, and subsequent investments are going to dilute our position, and then we typically have at least a pro rata right to invest in the next round, which we often exercise at what's referred to sometimes as a super pro rata level, which means we invest more than the pro rata that we're contractually able to do, because the owners, the founders of the company want us to put more money in, and we want to put more money in. So I can't think of a single time now, to Alex's point, where we said, that extra $4 million, $2 million, $500,000, That's a little bit more dilution that we really want to take. I mean, that simply does not happen today, because it's not like you can pick and choose among investors. So if somebody's willing to put money in and you can raise a little bit more than you targeted, and you're going to take dilution because of that, do it. And that's been our advice every time, and I think it will ultimately serve us well and the founders of the company and everybody who's on the cap table, all the shareholders. Valuation has become probably less of an issue, and dilution associated with subsequent investments less of an issue when you're moving from pre-seed to seed, and then even seed to A and beyond.
And so using a SAFE, you can raise $100,000 without spending $20,000 on legal fees to do it. So I think it's, yeah. So, we also kind of mentioned like any dollar is a good dollar, using a hybrid model of using some SBIRs, using some equity funding, using incubators, this type of thing. So the SBIR program actually was passed into law in like 1979 or something.
1982, I think, is when it.
Okay, but the original, yeah. So behind you, this original one, the whole program was put into law. So they give you a couple $100,000 to give them a plan for your prototype. The government gives you, $1.75 million to build that prototype. And then in phase 3, they buy the product that they paid you to develop, right? But 20 years ago, it didn't really happen. So we used to refer to phase 3, where the government bought it, as Bigfoot, because everyone had heard the term, but no one had ever seen it with their own eyes, right? So that was kind of the standing joke about 20 years ago. So what did companies do 20 years ago? They went straight back to phase 1. They got on this treadmill of doing nothing but SBIRs, right? But now you have, there's a, and maybe if you can kind of speak to this too, one of the government solutions from that, led by people like Andrea, was they use a vehicle called OTAs, Other Transactional Authority. So just like DARPA, where they can give you $3 million, that phase 3, they can give you $3 million, $5 million, right? So it's it really is kind of, can really augment like a large funding round. So last year, I think SBIRs were $3 billion total, and OTAs were $12 billion.
So maybe I can jump in on that. The OTAs are a complicated question. So OTA is an Other Transaction Authority, and it's a type of contract to do work with the government that doesn't have the same acquisition regulation issues that the SBIR contracts have as more traditional contracts. There are parts of the government where OTAs are used, and an example of that would be DIU, the Defense Innovation Unit. It used to be called DIUX. Their model and their goal is to connect you directly with the defense community, so that if you're developing something that the government can use, this is a way to accelerate that. I would not suggest thinking about OTAs as your principal way to get government funding. The OTAs exist in specific places, but every major agency that has a significant R&D program has an SBIR program, and that's really walking in through the front door. So I would be very careful about how you think about OTAs, and go, if that is an interest, it will become evident when you're working with those specific agencies or offices that use OTAs as their contract vehicle. In general, I would focus on the SBIR opportunities instead.
Yeah, but it's not a brick wall after phase 2 is my only, and I'm not speaking for the government.
And this question about the government buying your technology, in the case of the National Science Foundation, they don't buy the technologies. Their mission, which is basically to support the nation in multiple ways, does not require that procurement function. Whereas DoD, you could imagine having some kind of a procurement opportunity there, or with NASA. So again, it's a different type of customer discovery, which is understand what the agency is trying to accomplish before you write your proposal.
So you get this money, you're developing a prototype, or if you're in software, you're developing a minimum viable product, MVP, right? So to anybody on the panel, how minimal is minimal? Like what do you need to do? What can you, yeah.
Based on whose lens, VC or yourself?
Yourself, based on the 3 PhDs and a dog. What can they should hit it out of the park, but if it's not out of the park, does it need to be a double, a triple, and not vaporware?
Right, it can't be vaporware, but how to think about your minimum viable product will be evident when you do your customer discovery. And for you to dictate that in advance is probably not going to be as effective as when you understand from the customers and from the marketplace exactly what it is that they're looking for. You can probably get by with something that is a little bit hacked together if it actually solves a problem. And so I would focus the energy not on this is what defines a minimum viable product, but this is the minimum solution that somebody is asking for. Maybe you want to add to that.
I look at my runway, my cash runway, and what do I have? I mean, when you're at the beginning, you really are on a shoestring. And so you do the best you can and go out and test it in the market and find a customer who's willing to say, yeah, if you brought that to market, I would buy it. And it's again, it goes back to what I was saying on my slide is how well are you selling what you're trying to build to the customer and then therefore to the VC. The MVP is, again, one of these arts versus science kinds of things. But if you clearly understand what the market needs and you're able to show part of it with enough risk reduction and then convince the investor that, yep, that's it, then, to me, the proof is in the pudding. Do they write you the check?
This is why it's really important to have people on your team who are seasoned and who ideally understand the industry that you're interested in tackling, because the people with industry insight will help accelerate that discovery process and thinking about how to formulate this.
There's also tricks, not that I want to say there were tricks, but like if you're doing a hardware product, sometimes just making a 3D model of the product and showing it, putting it on the table, even though it doesn't do anything, changes people's mental perception of, oh, they really know what they're going to build. And so I know that sounds silly, but it's just like even your slideshow. Spend a little bit of money to make the slideshow look really polished, because you're creating an impression with every time you speak. So having, it's just one of my little tricks.
So at Free Flow Ventures, we invested in human health and planetary health. Planetary health overlaps very directly with Julie's area of responsibility in material science. So for planetary health, in simple terms, I think about it as either a prototype or a beta. Could be a mock-up, like Julie was saying, that just shows that you have some sense of scale and how the pieces fit together. But preferably a beta or a prototype that you can give to a customer, or you can give to an independent third party or somebody that can actually use it. And it doesn't have to be pretty. It may not be assembled at the nano scale that you ultimately want to deliver, if that's where if that's your strategy. But just have something that works. Again, in very simple terms, but there are a lot of different ways to skin that cat. And one of them is if you don't have the money or the runway, to Julie's point, then a mock-up or a prototype or a great presentation can actually go a long way. In human health, typically therapeutics, diagnostics, drug discovery tools and platforms, or like Alex's company, a medical device, then if it's a medical device, you want a prototype or a mock-up or a beta version. If it's a therapeutic, you want to have something that shows efficacy either in vitro, in a test tube or a petri dish, in silico, in simulations, or in small animal models like rats or mice or something like that. If you're making a therapeutic, if it's a diagnostic, then it's something that can detect whatever it is you're trying to detect, whether it's a disease or toxicity or efficacy. Then you want to just show that works. So it does vary based on the industry and what the sort of threshold considerations are for minimally viable product.
All right. So again, the forum has been around for 40 years. Most of the committee members that are here have been on for like at least 20. So there's always, a lot of times you see the person that's been super successful, made piles of money, And whenever they talk about the story of the company, there's always this point of this kind of serendipity of, and then I got on an airplane and the person sitting next to me happened to be this person who unlocked blah, 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 right? So you make serendipity happen by all that shoe leather, by all that effort, by not getting a whole lot of sleep for a very long period of time. So what kind of advice do you have for like finding the right people, going to the right events, like networking? What would just, maybe if we go down the row, like, or from either side, Alex or Julie, like what advice would you have to the young postdocs in the
Well, I got incredibly lucky. My first roommate in medical school was Shane, who discovered our technology here at Caltech, and we both shared a passion for advancing medical technologies. It's what I had done before I came to medical school and what I was set on doing at some point in my career. Didn't anticipate it was going to happen this early, but Shane and I we met. The first person I met in Los Angeles when I came to school here, and we actually were fortunate that we actually had started a different company together. So we had navigated how to manage customers, how to manage cash challenges, and we'd also done quite a bit together with respect to publishing work. We published over 35 papers together at this point. So that was our moment. But for people that aren't as fortunate to have the situation that I was gifted, going to as many events as you can like this is really the best way to do it. There are tons of networking events in Los Angeles in life sciences, medtech, through Caltech. Obviously, there's a ton through the universities, through USC as well. But there are also some private groups, like for example, SoCal Bio, Bioscience LA, MedTech Innovator is also technically based in Los Angeles. So going to a lot of these events, you will meet plenty of people. And then as you expand, as you get to know people like Kevin, and for us it was Julie and Helen and Jay, their networks are huge. So if you have, when you're trying to build your team, especially your co-founders, and like Julie had mentioned, clearly defining roles, once you know what that missing link is, you can ask people in your network to help you find them, as well as just going to these networking events, talking to people. And the most important thing, and it's also kind of like this is very similar with VC as well, is that it's the Brian Wynn analogy from his intern presentation, if you remember, is that you don't marry the first person that you date, right? So getting to know these people, getting to know what challenges they've navigated, what their experience really is, because everyone can make a good resume, but really what's the meat of it, and what are they going to contribute, and does it fill that link that you need? So again, going to all these events and finding individuals through your network and taking your time to establish that relationship so that going through that founders agreement that Julie presented, what's going to happen, because running a startup is a roller coaster. There are many times where, wow, we are toast. And then there are other times where the highs are really, really high. So having someone that you've seen, you've either navigated with them and not with your original company, which we had the fortune of being able to work together on multiple different accounts. But if you don't have that opportunity, trying to get references to say, okay, has this person done this before, right? And are they going to be that person that's going to fill that link?
Yeah, so this is not a paid commercial, but I would say do this. Come to events like this. That's why I'm here, and it's probably helpful to just quickly connect a few dots. So Free Flow Ventures to date has invested essentially exclusively in Caltech and JPL startups. One of our investments is Stroke DX, which is led by Alex and Shane. Caltech is also an investor in Stroke DX. And while we weren't on Julie's slide for OTT, because we're not part of it, we're independent of Caltech, but we work very closely with Julie. And Julie, I share the same view that you have of me with you, and I consider you to be a venture capitalist plus, because you do a lot more than just provide capital. You actually provide guidance, interns, and a host of other resources that you can draw from the university. So I come here for about a week at a time. We started investing in 2020. We've made 31 investments at Caltech and JPL since the first quarter of 2020. When I'm here, I stay at the Athenaeum, and my office is the Red Door. So I hang out at the Red Door. And if you wander by there a week when I'm here, you'll see me there. And I meet people there, I see people that I know, and then we sit down and have impromptu discussions, and that's somewhat analogous to being on a plane and somebody sat down next to me because the Red Door is strategically located sort of in the middle of our campus. Everybody, faculty, students pass through there. So, you know, it's like create the opportunities for you to network and to meet potentially valuable people to what you're trying to do. And that's industry conferences, all the things, you know, Alex, that you mentioned. And I also want to say that Alex and Shane are like phenotypical, excellent, in their DNA entrepreneurs. And we're thrilled to have them as one of our portfolio companies. And they solve the riddle that Julie put up there with those two overlapping circles. Both are or will be MPs, one PhD. I don't know how many dogs. But Alex runs the company day to day. Shane was the inventor, and this doesn't happen every day. But they presented a really good solution to the management team. Who's getting up every day, taking care of the day-to-day operations, and who's the visionary and creating the next generation of intellectual property, the next patent application, the next use case. So anyway, sorry to get off topic a little bit, but do this, and you can knock off, you know, 4 or 5 meetings that you otherwise would have had to do individually.
I have a lot to say on the topic of networking, but I will not say it all right now. You are definitely doing the right things. When I went to my first networking event, and I think I walked out with 2 business cards total because I was so introverted. I had gone to school here, and I used to call it THT, which stood for that horrible thing, because I would say things like, "Remember I went to THT and I met that guy?" I was fortunate that it led to my consulting practice and everything that happened after that. The key, I think, is not to walk in thinking about, oh, I need to meet so-and-so because of my needs. We're talking about you don't marry the first person you date. It's also better to think about it as something that you can bring to the table, and what is the opportunity that you really are affording to people. So if you think about it as a more giving and not as a taking, you will have much more success in your networking activities. Ask people what are they interested in, what are they looking for, what is it that is their biggest pain. By the way, all those questions are the same ones you would ask when you're doing customer discovery anyway. So I agree with all the statements about it's so great that you're here. You just need to do this times 1,000 in order to build your Rolodex. Do people still use that term? Thank goodness, yeah. Up here, some of us use the term Rolodex so that you can really then build all the functions that you're going to need to in your company, not just the capital, but everything that comes after that.
So I have 3 pieces of advice. The first one on networking. It would never dawn on me to ever ask anybody what kind of networking I should do. And the reason is because it just happens to be one thing that I do naturally. I wake up in the morning, I network. I just have always been that way. So what I've learned in startups is that you're under a lot of stress in a startup all the time because you're always dealing with your lack of resources and when you're under stress, people tend to default to their strength. And what I've seen here at Caltech is some of the most brilliant and talented people that I've ever been around. They just don't like to be around other people. They're not good at networking. They don't want to do it. And I'm sort of the mind that if that's how you feel, you probably aren't going to be very successful at it to begin with. And so my encouragement would be, first of all, if you're a CEO, you probably need that skill, so maybe you need to rethink your job. And number 2 is, if you're not that person, make sure you got one of those on your team. Because I always think that, when I look at investments and I see that the tuba player is playing the flute, I'm like, you really want to play to your strengths because everything goes better. So that's number 1. Second piece of advice, you're going to be calling on a lot of people, and you win awards, and Alex said it's a roller coaster. It is a roller coaster, but I want to say that it's never as good as it seems, and it's never as bad as it seems. And one of the things that happens when you're raising money from trying to get people to give you money, I was doing due diligence for a very well-known VC on Sand Hill Road, And I sat in the room and I watched this entrepreneur pitching his guts out. I mean, I was like, that was me. I was just having such a reaction. And then the VC at the end said, oh, thank you very much. Really good pitch. We'll think about it, and it might be a little early for us, might need to be a little further along than us, but really enjoyed that. And I said when he walked out the door, goes, that was an unfundable pitch. Why did you say that to him? Why didn't you give him real feedback? And he said, well, because in the event that he succeeds, and I said no to him, he won't come back to me. So I just try to, encourage them along. And as an entrepreneur, you need to be fighting for the truth. And that's what I try to do with the people that come to Caltech at the early stage, is to try to say, here's why that's not going to work. And sometimes people don't like to hear it, but you know what? It saves you a lot of heartache. Final point, and I'm giving more general tips. Diana Nyad used to train over at the Rose Bowl. She, at the age of 60 or over, she decided to complete the goal of swimming from Cuba to Florida. And I don't know if anyone saw the movie. It was pretty interesting. Covered in jellyfish stings. But as she was swimming, she would say one mantra: find a way, find a way, find a way. She would repeat it again and again. And in more moments in my career as I was doing this, and where everything looked bleak and totally bleak, I would just start repeating that. And you know what? The serendipity would occur. Now, obviously I was working hard, but just keep that in the back of your mind.
Yeah, so entrepreneurship is definitely a contact sport. So maybe if we're going to go to audience Q&A in a minute, give you plenty of time to ask questions to the panelists, and then at the end, the audience will rush the stage and trade business cards. But maybe as one last thing, if each of you can give like your one takeaway, like if you have, having seen the audience, having seen your fellow panelists, what is like the one bit of wisdom you would share at the end? So in any order is good.
Yeah, so Julie's second point, Julie and Helen, when we were first forming the company, and when Shane used to live in the tech transfer office. He used to be there every single day, pitching and refining the pitch. But I want to echo what Julie said from her second point, because we saved probably a year with your help for us to be able to refine our deck, and to, for you to tell us that we're crazy, and to not say, oh, we're gonna impact every single part of the neurodiagnostic market with this incredible sensor, and you're like, no, you don't say that. I'm like, okay. Whereas other places other presentations we go, everyone would say, oh, interesting tech, but too early. That's what no one says no, nobody. And we're told no about 300 times. So that's another thing I want everyone to take away is when you get told your 100th no, you're only a third of the way there. So just keep going. And even if you're $100,000 in debt because another VC smoked you and took you through diligence, and then you run out of money, you think you should quit, then don't quit. Keep pushing. It never happened once, but it usually doesn't happen, so we can talk about that later. But what I want to stress is that this is a really, really important and valuable ecosystem here at Caltech, that we would not be as successful as we currently are without the team here. So use every resource that you can here with respect to just going and sitting in the office and running through some of your ideas, and be ready to be beat up a little bit around some of the claims you're going to make, but it's only going to make you stronger when you actually go into that room where there's someone that will write you that check. So being persistent and making sure that you continuously are refining your presentation and your deck. I think we had probably 50 revisions in our deck over the course of a year that we were pitching while we were in medical school. The second thing that was incredibly valuable for us as we were approaching, it's kind of one and the same what I was saying before, but when people say no to you, make them tell you why. If there are a lot of good people in this ecosystem that will help you. There are some that aren't, but there are enough that will. So when someone tells you not now or no, try to get them either to give you 10 minutes of their time to explain why. These VCs they have seen, if it's not the exact same approach to the market, they likely have probably seen some of your competitors. They can tell you exactly why, and they can help you in ways that you may be afraid to ask, but you need to ask. And then the last thing is that if they truly are saying you're too early for us, right? We got that a lot for we're investing in commercial companies and say, okay, great. Since you like the technology and you want to invest in us in Series A, who can you introduce us to? Because the best way to get to an investor is through a connection. Cold emailing, you need to do it. Be selective with it, because a lot of people will just take up your time because they want to learn about it, and they also don't have money, so they want to just get their potential deal flow in. But ask for connections, because that is really where we raised our first round, is through people that we met by networking, and none of our cold, a few of it, two did, but most of the time it was not successful. So those are my last parting thoughts. I just want to thank Caltech for having me, and this has been really great, and happy to help in any way that I can and share what we've learned over the past couple of years.
I would certainly agree with Alex's comments, and I think if I was just going to focus on one thing, it would be a topic that we haven't really talked about, which is a term sheet. And the term sheet is just a really critical aspect of fundraising, not necessarily so much for pre-seed. And Lynn asked about the SAFE, and one of the other things that a SAFE does, it sort of eliminates the need for a term sheet, because everybody understands what's in a SAFE and you can't change it. So you just say you're opening a SAFE, and then people can invest in it, and that is often sufficient if you need more than one investor. And if we looked at the numbers, fewer deals but more dollars. So these you just need to raise more money now because of what we talked about before, because it takes longer to raise the next round. So that's upping the ante. So if you're going to have multiple investors and you want to do what's referred to as a priced round or use some other structure, getting a term sheet is a seminal threshold event. And when the difference in the conversation that you have with a VC when you have a term sheet versus when you don't is night and day. And the deeper you get into fundraising, into the seed round and then beyond, the more important that becomes. So that's like, find a way, right? Find a way to get a term sheet, and then doors will start to open. And if you need to have a syndicate of multiple investors, that is the key event, and it just didn't really come up in any of the questions. So I felt it would be helpful to just share that now.
Find a mentor, or 3 or 5, if you don't already have one. So at the Charity Startup Garage that I mentioned, that Dave runs, we have an Innovator in Residence program, and Julie Hentiscus, who's in the audience, has served as one. If you didn't follow every word of what he just said about term sheets, and you're not clear on what is the difference between a discount and a cap and a safe, find someone who will sit down with you over a cup of coffee. They'll probably buy you the coffee, and go through what all of those terms mean, the words, what they mean in a term sheet. Find mentors who can support you as you go through your entire process. There are a lot of people who generously give their time here, who want to be part of growing this activity here in Pasadena, growing it in LA. So go look for mentors and do your homework as you walk into those conversations. At least Google is a marvelous force. Learn everything you can. So that would be one set of recommendations that I would make. And then the listening part. It doesn't matter how much you read about term sheets if you go to a meeting with someone who's at General Motors or wherever, and you don't actually listen to what they're saying in terms of what they're looking for. These are two pieces of advice out of the many that I have.
Yeah, sorry if we're sounding like, do this. But be coachable. That's my advice. Be coachable. Alex and Shane came to me in the early days, and we went through 50 pitches, and it was a joy to coach them, because every time I gave them advice, they not only took the advice, but they enhanced it. They understood what I was driving at, and they made it better. And for someone who's helping, nothing is more frustrating than to say something to someone, have them come back, a week later or a day later, and it's clear they didn't hear you or chose not to listen to you. And that tends to be a predictor of success, because as I look around the portfolio of companies that I've worked with at Caltech, the ones that are really making progress are the coachable teams. Coachable meaning they are not afraid to ask for feedback. They are not defensive when you give them feedback. And as my poor son who's in the audience knows, I'm not very good at giving feedback gently. But they can handle it. And they take what you're giving in the right spirit and they turn it into something big. So that's my advice.
So my wife tells my 16-year-old to go to medical school, but now she's going to say go to medical school and get a startup funded. So now I have an entirely new set of problems. So we're going to go to audience Q&A. We rotate left to right. So if you raise your hand, Russ on this side or Stan on this side will give you the microphone. You can, again, we rotate side to side.
Thank you. This is so much good practical advice in one place that probably I've ever heard in a panel. I really think so, so I appreciate that. I'm going to raise a couple of things where I don't completely agree or I give a caveat. For you, Kevin, safes, they're not simple. And I've seen so many times where people over-raise and think they're doing something really, really well. We raised 4 instead of 2 and on a $10 million post cap and don't realize that they've now given away 40% of the company. So there are catches to it. Andrea's advice about have someone walk you through these things. There's plenty of people who will do it and do it for free because it's not that simple. For Julie, who I've worked with for many, many years, the problem, identify a problem, how are you going to solve the problem, obviously essential for pitching. The observation I will give you to see if you agree with or anyone else on the panel, with that being true, some of the most successful startups I've seen in the last 10, 20, 30 years have been companies that started going down a path and have completely, or at least significantly changed what problem they're solving, what market they may even be addressing through the years. Is that still a true statement? And
100% true. It's what's known as the pivot. When just because you identify the problem that you're trying to solve doesn't mean that you solve it, or B, it's the right problem to solve. But by putting one foot in front of the other every single day, you may discover a different problem. I was looking at things that I had done in my past, and I think every single thing that I did pivoted into a different problem. So it's an excellent point.
Yeah. So I actually have a...
And by the way, the person who asked the question, Brad Schwartz, has been a terrific mentor to startups all over San Gabriel, all over LA, but has been an advisor to me. So if you don't know him, you need to know him because he gives great practical advice as well.
So I have 2 pivot slides. One, as Stephen Wright said, there's a fine line between fishing and just standing on the shore like an idiot. So knowing when to pivot is hard. But my favorite saying is that more companies dive into just things. It's not that they go after it. As Kevin said. So question on this side?
Hi. Can you guys hear me? Pleasure to meet you. Thank you so much for taking the time. I have a question with regards to raising that first round. Is there a reason why a company should delay raising the round as a way to maybe gain more leverage when they're raising the round? Or in other words, the question is, are there some key metrics that a startup should attain before even daring to go raise the first round?
So when you say, just maybe you could elaborate a little bit on delaying, that implies that you are able to delay raising the round because you either already have enough money or you're going to wait to start the company.
So I think the question's coming from experience. I fairly sell money.
We do a software for fleet management, managing secondary cost in fleets. and we already have 17 fleets in the platform, and I'm just a little bit scared of raising money, because I feel that I can maybe get a few more customers on the platform before I show the product to investors.
That's all. So, there's certainly have to be quick to acknowledge that there is a necessary evil aspect to venture capital. It would be silly to say otherwise. So if from family, friends, and hopefully they don't turn out to be fools. So this, family, friends, from customers, from revenue, from non-dilutive capital, from your own capital. Well, there's a lot of philosophies about how much of your own capital you want to put at risk. But to the extent that you can get by on that, and you don't feel like you're losing an opportunity to create a competitive moat, or to get a first mover advantage, or other things that are time-based, then you should only take venture capital when you absolutely need it. Because as I mentioned early on, once you light that fuse, you can't put it out. So you now have obligations and there are expectations once you take venture capital. You should only take it when you absolutely need it. Which turns out to be most of the time.
Yeah. All right. Thanks very much. I had a question about a lot of investors who seem to require that the founders be full-time. If your company literally has no money and you need to pay bills, what's the best way to address that concern?
You say, when I raise the funds, I will be full-time. They're expecting that, and, I think that works every time. I've seen it work.
So there is a dynamic here at Caltech, which we've seen happen now repeatedly with over 30 investments, all based on Caltech startups, and that's where the academic founder, often a tenured member of the faculty here at Caltech, who doesn't want to walk away from a tenured professorship position, and they're allowed by university institute policy to dedicate roughly 20% of their time to other things, and it's not really clear to me how tightly that's enforced. But what is clear is that we have, as an empirical matter of fact, we have a host of companies that have an academic founder who spends roughly 20% of his or her time on the company, but then we have an operator, CEO, general manager, president, whatever title, who is 100%. So you can sort of get away with somebody that's not 100% if they're not in an operating role. And when Julie went through those equity breakdowns, you saw there were certain tiers there that tie to people that there's passive academic founders and then there's active. In the case of Caltech, an active academic founder is probably spending, meet their academic responsibilities, then they're doing anywhere from hours to days a week. And it varies from one company to the next. So you need to have somebody who is full-time. Someone who gets up, in the case of ShortDX, in the morning, thinking about what to do next, and goes to sleep, thinking the same thing. What am I going to do tomorrow? So you just have to have that. And that's another reason why $500,000 for a pre-seed doesn't really go that far.
Let's do two more questions. I'll ask a question. I don't see any hands right now. Over the years, these terms have changed. Seed used to be at the very beginning. Now it's no longer a seed. Would you just briefly explain the sequence and where A and B now used to be D and E? Just explain that, what those terms mean in today's market.
So actually, what's happening now is that it's a linear progression, but now there are a lot of intermediaries along the way. And what I mean by that is there's pre-seed, then there's a seed, and then increasingly we see a seed extension, or a seed prime, or seed alpha, and then a seed beta, a seed 2, and then we're even seeing that with the A rounds. You see, then you get to an A round, and then there's an A extension. And one of our portfolio companies, our first investment, just did a Series B extension, meaning that they raised more money on the same or similar terms to what they raised, in this case, $100 million last year in Series B. So there are certain expectations around Series A. A lot of companies just don't get there from the seed, so you're in this you're in this gap. So the solution, the recent solution, has just been to basically extend the seed and use any number of different, any kind of nomenclature to name that. And so the dollar amounts now, it's really hard to assign like specific chunks to each stage because it's a very dynamic process and it's almost company specific at this point. Sorry, I don't know, I came off the mic here, but yeah, so it is linear in that sense, but now there's a lot of stops along the way, particularly before you get to the Series A, which is a really important sort of milestone for our company.
Where does the valuation increase occur in this step? If there's an extension of A, is there a value increase between A1 and extension A2 and so forth?
That also varies, and it's often a function of time. So if the extension is done within several months of the round that you're coming in onto, that you're extending from, then it's often done at the same terms. Bear in mind some of the statistics about flat and down rounds. So we're seeing, a lot of flat rounds now, and we're experiencing an occasional cram down round as well. So that's a reality of the market today. But when you get to a Series A, you want to see, a lift from whatever the last round was. That's part of the threshold nature of a Series A, is that includes some kind of a markup.
One funny story on labeling the rounds. When I invested in Ondex in 2010, it came, Dave's already laughing, it came to the Pasadena Angels. And I had actually seen the company several years before with a client of mine who was a venture investor. And it came to the Angels labeled as Series E. And I thought, oh, E, that's a letter we don't often see in the Angels. And that was how that financing happened. So I think the labels, that some of the words maybe have changed, like this seed prime, but this dynamic that it's the financial reflection of the roller coaster that we heard about. It's not just an emotional roller coaster, it's a financial one also.
Yeah, just a quick addendum, don't rush to a seed round unless you're at a seed round. Some founders just feel like insulted by pre-seed because they're like, no, I'm not a pre-seed, I'm a seed. But now you just you already skipped a step that you otherwise could have exercised for a more normal, logical progression. So, if the investor says that you're a pre-seed, you're probably a pre-seed, and for them you will be. So the only way you're going to get money from them is it'll be a pre-seed round. So don't push for a seed round unless you have a good reason to do that, and let the progression play out and sort of give you more optionality and serve your purposes rather than out of pride argue that, no, I think this should be a seed, because that doesn't really accomplish anything.
And I'd just say it another way, because I've seen this all the time, is that, in school you're used to your GPA or your IQ, and people look at their post-money valuation as a reflection of how wonderful they are. And it's really a ratio of, the number is meaningless. It's how much money did the VC take for the money they gave you, and can you, in 18 to 24 months, raise the value enough that you don't lose too much more of your company. It's a flywheel equation, and if you look at it as, oh, I have an $80 million post-money valuation, then I'm hoping you're not running that company.
They own the trademark for the seeds for outline.
Yeah, I have a question for Andrea. So in my previous life, had a lot of experience with government contracts. And so we had a way to evaluate which of the RFPs are somehow wired, they already know who they want to award to. So I just want to know, maybe just for the audience, how fair the process is for SBIR and STTR. I know we bid on some OTAs, and we put a lot of effort with a bunch of professors, and we didn't even get feedback. You put like hundreds of hours in OTAs, and they didn't even bother to even give any kind of a feedback. So I'm just curious, is it even for entrepreneurs, is it worthwhile pursuing the path of SBIR and STTR? Oh, sorry.
One thing I want to add to that as well, that something that we've learned as well, is that when pursuing non-dilutive mechanisms, you need to be very selective, and you also need to be very realistic. So evaluating what they have funded, because for us in particular, so we're in the neurospace. There's a division of the NIH. The military is also very interested. NSF's also very interested. And so when we were trying to raise money and we didn't have access to funds, we were like, Shane and I both are very strong academic writers. So we just wrote and wrote and wrote and wrote and wrote. And now reflecting on that, we probably submitted to 2 or 3 grants that we just should not have. It was just out of scope, too big for us, or just if you look at the companies that they fund, it wasn't us. So I think that there's a good piece of advice I can give is that look at who they fund, dig into who those people are, and then try to paint yourself in the finalists that actually got funded. Because I think a lot of people are like, oh, it's a $6 million grant, we should go for it. But if you look at who's getting those grants, these are companies that have raised 2 rounds, right? So for us, we made that mistake once where we applied for a grant that was too big. So now we scope and go for grants that are, company stage appropriate. So it's something that everyone should just be aware of, because these grants do take a lot of time. And, the benefit of writing these grants too is also for the VCs. It forces you to go through the exercise, and it's different than the academic grants. Very, very different if you've had the experience with it, because these individuals are not. There are the academics reviewing them, but these are also. It's almost like pitching to a VC. So writing that 12-page commercialization plan and then getting it torn apart by the NIH actually helps you a lot when you go talk to someone like the 3 individuals on the panel here that could invest in you. So it's painful to get rejected from grants, but if you spend a lot of time digging into which grants are appropriate for you, and then you take the benefit of those applications with respect to honing your focus, you will start to smile even through some of those rejections.
And just on the subject of grants, very quickly, a lot of people are under the impression that once you take private money, once you take venture capital, that you're no longer eligible for grants. That's just not the case. There may be some that are grant specific that have those conditions, but generally speaking, every one of our companies in which we've made venture capital investments is pursuing some type of grant at some level at some point in time.
Yeah, it can't be majority owned, and it also the work has to be done by U.S. citizens. Also, NIH and NSF tend to be bottom up, where you turn in what you have and they grade it. DoD tends to be very specific about something they want. So you sell the program manager, and then you see a grant that says this has to be in this. It has to be on Colorado Boulevard. Your first name has to be Alex, and they kind of, it's a little more targeted, right? So. Oh yeah, I'm sorry, a green card holder. So.
And one other thing too is an investment in a grant manager pays off for every dollar you spend another 1,000, because if you forget one, you just want to be able to focus on the science and the business. And there's so many rules for every single different grant that if you forget one formatting issue, the whole grant's gone. So that's another thing I highly recommend and they're affordable. So that's something that we have spent money on that we will never regret.
So if you want to download this slide, it's on our website. If you just Google Caltech Entrepreneurs Forum or you go to intforum.caltech.edu, you can download that slide if you want it. And as I mentioned, the company Honey that recently was a $4 billion exit, they sold for $4 billion. The company founders met in this room at one of our events about 7 years ago. So please do that. What's up? Okay. Yeah. Okay. We're way past our time. Everybody will have a chance to talk to the speakers, but we have to be mindful of the audience's time. So this one? Yeah. If you just Google Caltech Entrepreneurs Forum. So, again, our next event, what's it? No. Unless you corner them and follow you outside. So. For a small price, the forum will, no. So.
Why don't we just send them out, slides? We'll make them available on your site.
Okay, if that's okay, then we will, it's kind of unusual, but we'll put it on the website. Yeah. Also, you're going to get a survey emailed to you. So our next event is going to be June 1st, and it's going to be pure war stories, a really fun event. It's called What I Learned from My Startup Getting Screwed, right? The whole theme of learning from failure that you've heard in this event, you're going to hear it from very top investors. Like I said, Wes Nichols runs all enterprise AI for March Capital. Jeff Steibel was Kobe's partner, and Bryant Steibel. A lot of you probably know Shaheen Farshi. So you will get an email this afternoon with a survey. We take those very seriously. If you can, give us your feedback, that type of thing. You can scan that. This is the link, but it will come to you by email. So with that, I'd like to thank everybody one more time. And there we go. So I'd like to thank all the speakers one more time for coming, and you're welcome to talk after.